And disappointment. 2Q GDP contracted 4.6% versus 4.2% expansion the quarter before. Estimates were for a contraction of 1.5%. Year on year, 1.7% growth versus 2.8% the quarter before. So the numbers much worse than expected. Now, Singapore's growth easing for the first time in a year. It shows the weakening prospects, not just for the country, but for its neighbors elsewhere in Asia. It shows headwinds. China, for one. Take a look at industrial production. It fell in May. It's dropped for 4 consecutive months. And that's because Singapore is shipping fewer products to China, to Europe, not helping that Greece is now adding to risks in Europe. China, though, is a key market for Singapore, far more important than any other. Some economists say, as long as China doesn't see a pickup in growth, the negative effect will trickle down to Singapore. And right now, there are few signs it's about to get better in the second half. And unfortunately, the growth momentum we're seeing in the US and EU cannot compensate for China's slowdown where Singapore is concerned. Ange.
Yeah, and that is going to really flow through to the markets today. What can we expect here?
Well, the government's prediction is between 2% and 4%, but some economists are tapering expectations for the year. Just yesterday, DBS, the largest lender in Singapore, cut its estimate for the year, now 2.4%. Previously, it was 3.2%. If that's the case, it would be the slowest growth pace since the global financial crisis. Now, as you may know, manufacturing is the biggest risk. Sentiment pretty much muted. And don't forget the labor crunch we've been talking about in Singapore with government measures to limit foreign workers. Companies are finding it hard to fill jobs, more expensive to do business in the Lion City. Citibank, it says, keep a close watch on employment this month. As for the market, well, taking a look at the numbers, it's going to be probably a red day.